let's take a look. I'm going to show you a couple of examples. These are case studies, specific, not even case studies, specific examples, anecdotes. And I be quite clear, anecdotes are good for understanding, but they don't in and of themselves create much, they're not statistical evidence. So in our paper, we're looking at thousands of events. And we're developing statistical tests. I'll show you one slide from the paper, but the individual examples are a lot easier to explain. So here's my first example, ADMA Biologics. And what we're looking at is the blue line is, the orange line is the price, and the blue line is the number of Robinhood users who own this stock. And if you see at the bottom, we're looking at it changes over periods of a couple of hours. So this isn't over, it's over a few days, but the periods are fairly, it's fairly fast. And what you see is that the price went up, and shortly after it went up, the Robinhood investors or traders started to buy, and they bought and they bought and they bought, and they probably helped push the price up higher. And then the price went down, and most of them were still owning. Now that in aggregate, they lost about 14% on this particular example. Here's another example, which is Hertz. Some of you may have heard the story. Hertz filed for bankruptcy, and suddenly a bunch of individual investors got interested in buying it. So you see the Hertz price is going, it starts to go up. The blue line is flat for a while. That means that there are about 60,000 Robinhood users. It stayed at 60,000. And then over the course of a couple of days, it shot up to about 160,000 Robinhood users who owned Hertz. And that helped drive the price. The price went from $1 up to $6.50. So on a company that's declared bankruptcy, and the shareholders could end up with nothing and probably aren't going to end up with a lot. Sure enough, the price then tanks again, comes back down quite a bit, and the Robinhood users are still owning. And on average, the aggregate Robinhood user lost 43% on this particular event. And my last example is Kodak. And in Kodak, it's the same basic pattern, except for that there's a little tighter match between the Robinhood users. You went from about 10,000 people at Robinhood owned Kodak, and a few days later is about 130,000. So these people went on a buying spree. That buying spree spiked the price, and then the price dropped back down, and the people, especially the ones who were late to the party, got left holding the bag, and the aggregate Robinhood user lost 64% on this. Now these are anecdotal events, and they're obviously picked because 64%, that's very much on the high side. That's not what the average loss is when we look at thousands of events, but it is the typical pattern. So here's what we find when we look at some thousands of events. We start off looking at about 25,000 events in which there was a substantial increase in the number of Robinhood users who bought a stock in a single day. And then we look at more and more extreme events. For example, there were 1,000 events in which the number of Robinhood users doubled in one day. And on average, post doubling, the stock price fell about 9% over the next couple of weeks. And there were 160 events where the number of Robinhood users went up sixfold, 6 times as many. They went in one day. And those stocks tended to lose about 15% over the next several days.